you ever look at a trading chart, one of those ones just covered in squiggly lines and blinking indicators, and just feel completely lost? Well, what if I told you there's a way to trade that throws all of that clutter out the window? A philosophy that gets back to the one thing that actually matters, the price itself. All right, let's get into it. We're talking about price action trading. For most people, the daily up and down of the market feels like total chaos, just a bunch of random noise with no rhyme or reason. But the traders who live by price action, they believe the market is speaking a language. It's telling a story. And the real challenge, the real skill, is learning how to read it. So on the left, you see where most people start. The chart is a mess, right? It's cluttered with things like RSI, MACD, Bollinger Bands, the whole shebang. But here's the problem, and this is something author Bill Eichen points out. All of those things are lagging indicators. They only show you what has already happened. Now look at the chart on the right. That's a price action chart. It's clean, it's simple, because it focuses on the only leading indicator there is, the price, as it's happening right now. So what exactly is price action trading? Well, think of it as a method for reading the market in real time. It's all about looking at the raw up and down movement, the bars, the candlesticks, to figure out the psychology of the people in the game. It's way less about complicated math and a whole lot more about, reading the room. Now, to really get this, you gotta shift your mindset. Stop thinking about the market as some, abstract economic machine. Instead, I want you to start thinking of it as a strategic game, a battleground even, that's completely dominated by massive institutional players. The entire philosophy is really captured in this one quote. Trading should be viewed as a game played by the big boys, with savvy traders following in their footsteps. This idea is the absolute key. You're not trying to predict the entire economy. No way. You're just trying to figure out what the most powerful players on the board are about to do next. So what do these big boys want? Simple. Their main goal is to make the market move, because a flat sideways market doesn't make anybody any money. They want to buy from nervous sellers, the so-called weak hands, when prices are low, and then they want to turn around and sell to overly excited buyers when prices are high. One trader actually told the author that the name of the game is, and I quote, taking money from the public. And this brings us to a crucial point. You are never, ever going to beat these guys. So the goal of price action trading is to stop fighting them. Instead, you learn to spot their footprints right there on the price chart, and you follow them. You just ride their coattails. So how in the world do you actually do that? Well, it all starts before the market even opens for the day. It starts by creating a map, a playbook for the trading session. And this isn't about guessing. It's a simple, disciplined routine that anchors all of your decisions in what happened yesterday. Okay, this is a formula that is so simple but so powerful. It comes from the old school pit traders. You take just 3 numbers from the day before, the highest price, the lowest price, and the price where it closed. You add them up, divide by 3. That's it. That simple average gives you the single most important reference point for today. And that number is called the pivot point. The best way to think about it is like the center of a seesaw for the day's trading. If the market is trading above that line, the general feeling is bullish. Buyers are in control. If it's trading below it, the feeling is bearish and the sellers have the advantage. So your daily map starts with just these 3 horizontal lines: yesterday's high, yesterday's low, and today's pivot point. And these aren't just random lines on a screen. They are psychologically important levels where you can expect a fight between the buyers and the sellers. These are your key battle lines for the day. Okay, so you've got your map. You know where the battles are likely to be fought. But once the market starts moving, how do you navigate it? Well, for that, price action traders use a kind of compass. It's a tool that helps them measure the real strength and health of any move the market makes. Now, this compass is based on a really fascinating number. It's a number that pops up everywhere in nature, from the spirals in a galaxy to the shell of a snail. It's called the golden ratio, and it's about 0.618. Proponents of this trading style believe this natural constant, this rule of harmony and proportion, also dictates the rhythm of the markets. So in trading, this ratio helps us see how healthy a trend is. See, after a market makes a big move, it usually pulls back a little to take a breath. These Fibonacci levels, they act like invisible support zones. If a pullback is shallow and bounces off the first level, it means the trend is super strong. A deeper pullback is testing the trend's commitment, but if the price breaks all the way through that deepest level, that's a huge warning sign that the trend might be over. And this picture shows the idea perfectly. When the price starts pulling back like that, every single trader is asking the exact same question. Is this just a little pause, or is the whole thing reversing? By measuring how deep that pullback goes against these Fibonacci levels, a trader can get a much better sense of the probability that the trend will continue. It's a way to measure the market's conviction. So let's recap. We have our map to know where the action might happen, and we have our compass to measure the strength of the move. The final piece of the puzzle is learning to read the road signs, the specific patterns or tells that signal what the big boys might be planning to do next. One of the classic traps is called the J-hook. The market will make a move, and it's designed to tempt all the traders who are late to the party to jump in. But it's a total setup. Right when they feel safe, the big boys pull the rug out and slam the market hard in the opposite direction. It's a classic sucker punch. Then you've got something called the wedge. This pattern is a sign of coiling energy. You'll see the price start bouncing around in a tighter and tighter range. It's like a spring being compressed. You can almost feel the tension building. And when the price finally breaks out of that wedge, the move is often explosive. Another really powerful tell is what Bill Icken calls the Doji sandwich. Here's what it looks like. You get a strong bar going up, then it's followed by a bar of complete indecision, that's the Doji, and then you get a strong bar going down. That simple 3-bar sandwich signals a very clear shift in control, from the buyers to the sellers, or the other way around. Now, the most important thing to remember here is that these patterns are not some kind of magic formula. They're just visual snapshots of market psychology. They're like road signs that pop up at those critical intersections on your map, those support and resistance lines, and they give you a hint about what might happen at the next turn. So let's put all the pieces together. We've got our map, our compass, and our road signs. But it is absolutely crucial to understand what this toolkit actually gives you, because it is not a crystal ball. Let's be super clear about this. No system, none, can predict the market with 100% accuracy. And frankly, anyone who tells you they can is probably selling something. Price action trading is actually an admission of that fact. It's not about trying to be right on every single trade. That's a fool's game. What it is about is discipline. It is a method for consistently spotting those moments when the odds are stacked in your favor by combining location, that's your map, with trend strength, that's your compass, and a clear signal, that's your pattern. What you're really doing is looking for opportunities to gain a small statistical edge over and over and over again. And that really leaves us with one final thought. If you can accept that the market isn't some puzzle that you can solve, but that it's a game of probabilities, a game run by incredibly powerful players, well, that changes everything, doesn't it? It stops being about finding some magic indicator. And the only question left is this: knowing it's a game of probability, how would you play?